Hey, we were talking about this earlier, just kind of the shift in the momentum in the markets where investors seem to be turning away from the AI trade, seemingly largely due to valuation concerns. Healthcare, the best performing sector this week, generally seen as a defensive sector. Just your take on that momentum shift.
Yeah, I think it's to be expected a bit, Frank. When you go into a cyclical recovery powered by both monetary and fiscal stimulus, both of which we received in meaningful amounts this year, what happens is that those cyclical sectors, powered by operating leverage, kicks in, and you see earnings growth, or at least the second derivative of earnings growth, that is equal to, or at least somewhat approaching, some of those AI, cloud, some of the sectors we've seen outperform. And if you can get that same acceleration in earnings growth at much cheaper multiples, that's where you're going to see investors grow. So I think this is somewhat to be expected.
All right. I want to talk to you about the momentum in the market. I'm going to hit you with three key dates. So back on September 17th, that's when the dollar bottomed, at least this year. Since then, it's up more than 3% higher. Looking at Bitcoin, it actually peaked on October the 6th, and then gold peaked on October the 20th. All of them have taken, well, Bitcoin and gold have taken downside moves. The dollars move higher. What does that mean for this market? The fact that these, when we're talking about Bitcoin, a riskier asset has moved lower. Gold is safe haven. People are piling into that. It's having just an incredible year. Now that's cooled off, and the dollar has strengthened.
Right. And so the dollar strength is temporary and episodic, right? I mean, we're still down almost double digits on the year. Outside of that and a good month in July, the pressure's been on the dollar. And I think the pressure will continue on the dollar, Frank. When we look at the administration's goals of onshoring and bringing manufacturing back, they've all but stated, especially Moran, that requires a weaker dollar. But there's other factors that are maybe not as intentional. Lowering rates devalues the dollar. Obviously, it's relative to what rest of world is doing, and rest of world is in a stimulative posture as well. But we'll see how quickly those rates come down. Trade and tariff policy creates pressure as well, because as the rest of the world seems to be reinvigorating pacts outside of the U.S., that creates more demand, more relative demand for those currencies, putting more pressure on the dollar. So I think we have structural factors in place that will see 2026 be a lot like 2025. And despite some recent strength, the dollar's still down over about 9% on the year.
All right. Looking at this week in particular, as we mentioned, the major indices are on pace for a lower week. In fact, the Nasdaq's having its worst week since April. The Carson Group came up with some research I thought was fascinating, that the trend so far this year is that we see gains in the first half of the year, and then we see selling going into the weekend. I don't know if that's a response to some of the headline-driven moves in the market from the president or whatever else is going on. But with this in mind, especially on this week, what would you say people should do? Should you buy the dip right here, even though we know we're seeing this trend on Thursdays and Fridays? Should you hold off? I mean, what would you do if you were talking to a client?
I think you should buy the dip selectively. And I know you'll probably find that surprising coming from me, given our history. But I think you should buy the dip selectively. When we look out to the end of this rest of this year in 2026, we know that interest rates are coming down further. Whether it's in the immediate future or sometime farther out in the midterm, they're coming down. And so I think we can still place some confidence in a cyclical recovery here. And I think we can still place some confidence in earnings growth in sectors outside of tech. And I think if you're nervous about the strength of this cyclical recovery in the absence of the government data that we would normally have, you can still find sectors and companies and stocks, financials, healthcare, energy that benefit both from the cyclical recovery and that have the high international exposure, high export exposure that will benefit from a weakening dollar.